We've assembled a taking stock think tank to talk about LinkedIn. We have Jay Ritter. He's a professor of finance at the University of Florida. Jay specializes in initial public offerings. He's advised Google, for example. Also, we're going to have with us David Weild. He's the senior advisor at Grant Thornton. David is the former vice chairman of the NASDAQ. And we have Scott Kessler, the head of tech sector equity research at Standard & Poor's Financial Services. Now, he's been covering the internet since 2000. And also, we've got Julie Hyman, our senior markets correspondent. Let's start with you, Julie Hyman. You know, you've lived through the tech bubble like all of us. Does this sound at all reminiscent?
Well, you don't have sort of the volume, if you will. I mean, we're just talking about one IPO here, and some of the recent, for instance, Chinese internet IPOs notwithstanding, you know, as somebody said to me today, you don't yet have the pets.com. It's not getting silly yet, perhaps. So yes, you know, there are some things that make it reminiscent, but you don't just have the flood of deals that you had at that time.
Jay Ritter, flood of deals or flood of tears to come?
I don't think there are going to be a lot of IPOs either in this sector or in general. But one thing that is setting this company apart from a lot of the internet IPOs from more than a decade ago is the company has already established itself in the marketplace with revenue.
Well, if it's established its place with revenue, $15 million in earnings for a $4.3 billion valuation, doesn't that make you wonder about the future of the stock?
There's certainly a lot of optimism built in, but if the company had wanted to boost its profits, it easily could have done so by reducing its hiring spree to keep the expenses down. The company's been focused more on growth, with the revenue more than doubling per year.
Scott Kessler, does this remind you of a technology bubble in 2000?
Well, obviously, there are hints of that, right? When we were covering technology and internet stocks back then, I think that there are a number of distinctions to be drawn. First, as the professor referenced, LinkedIn is a real business right now. It not only has revenues, it actually has a well-diversified business model, and it's already profitable. And I understand that the profits are considered maybe somewhat meager based on standards that you might be thinking of in the context of public companies. But the reality is that, as has been referenced, this is a company that's been focused on growth, and they're really just getting started when it comes to monetization. So I think while it's reminiscent, it's not that similar in some respects.
Scott, I am curious to dig into the valuation a little bit more. We sort of did a back of the envelope, if you will, assuming that it would price near the top of the range. And that meant that it's pricing here at about 11.3 times projected annual sales, compares with 13.8 for Facebook, 8.3 for Salesforce.com. And I bring up the latter because some analysts have said, you know, this is really more like a Salesforce or some of these other companies like it, because LinkedIn gets about 70% of its revenue from business subscriptions, not from ad sales. Do you think that's a more fair comparison?
I definitely think, Julie, that it's a more reasonable comparison to draw. And I would also point you to the notion of what people have been talking about in this category on the M&A front, right, which is Microsoft is looking to buy Skype, and guess what kind of multiple they are prepared to pay for Skype, about 10 times.
We're going to have
revenue.
more on the David Weild. Come in on the topic. Does this mean that the initial public offering market in the United States is healthier now than it was last year at this time?
Well, actually, the backlog is up just modestly. There's about 120 IPOs in the backlog, and last year at this time there were only 110. But it's great to see stocks, you know, trading up in the aftermarket in huge demand. But this niche, if you will, of the social networking stocks, which create their own demand pull, is a little bit of an anomaly in the capital markets, and I don't think it's a great signpost for overall IPO market quality.
Now, David, you were talking about the retail investor and how companies such as Morgan Stanley leading this initial public offering is a little telltale sign about how the marketing is going.
Yeah, if you look at the cover of the deal, and there are three joint book running managers, two of them are massive retail firms. It's Morgan Stanley on the left, you've got Merrill Lynch rather in there, Bank of America, Merrill Lynch, and then you also have as another co-manager UBS. They all have massive retail sales forces. And so this product, if you will, LinkedIn, if it cuts across the exact demographic, that the retail brokerage accounts of each of these firms do. So there's huge instant recognition of this name, I would imagine, amongst the retail sales forces of these organizations. So this is as much a marketing and a branding event for LinkedIn as it is an IPO.
Jay Ritter, come in on this topic of retail branding and being able to sell your IPO, your initial public offering, to the right demographic group. Is that one of the reasons why social media is so hot among investors now?
I think so, but LinkedIn, as David Weild just pointed out, has unusual demographics with business people and professionals being their clientele. And, these are the individual stock investors. It's not Facebook users who are scrounging around for their lunch money.
Scott Kessler, come in on the topic of future IPOs for social networking companies such as Facebook or indeed even Groupon. What does this do to their valuations?
Well, I think these companies are closely watching what's transpiring with LinkedIn. LinkedIn has taken a slightly different path, right? This company is older than some of those other companies. It's more diversified now than some of those other companies. It hasn't raised capital recently like some of those other companies. But I think they're watching closely to see how LinkedIn fares, because LinkedIn clearly isn't as sexy or as controversial perhaps as Facebook or Groupon or Zynga. So they're watching, I'm sure, and waiting to see what happens.
Jay Ritter, how important is it for a company to be sexy in this space?
It's important, but investors, in particular institutional investors, are thinking seriously about what the future profit potential is. And there's a reason that LinkedIn's got a valuation in the $4 billion range, considerably less than Facebook.
David, what about competition?
Well, I mean, it's an interesting question, because in the employment market that they're serving right now, there's lots of different forms of employment. But it'll be very interesting because they have such a vast network that's growing at essentially pretty close to 100% a year, that they have so many people connected into this business network that really, at the end of the day, it's a question of what they can do to monetize that network.
Well, that was my next question. Is these people join the LinkedIn network free?
That's right. And there are various tiers of service, and you can actually have enhanced services and pay. And so they have a subscription business, and then they have a higher cost sort of sales force that goes out to businesses to sell the recruitment aspects of the model. But I think we've sort of seen the tip of the iceberg of what they'll do. I wanted to make a point that there's a really interesting guy behind this company. It's Mike Moritz of Sequoia, okay?
Right,
and
who's also hit a home run previously with Google.
With Google. I mean, he had to actually step down off the board of Yahoo to go on the board of Google. He was the guy that actually invested in and I believe brokered the transaction of selling YouTube to Google.
That's right.
So this guy's had an incredibly hot hand, probably not.
Former journalist from Time Magazine.
Exactly right. See, there is a future.
There is hope
for
in the future, right?
That's correct.
So you think that because of the backing of companies like Sequoia Venture Capital, that this is going to maybe spawn even greater investment in these kinds of companies? They see that they're doing well once. Why not do it again?
Well, I think they are. They're looking for the next great thing. But, guys like Mike are pretty darn smart. They're pretty connected, and they know how to build businesses. I mean, he's been wildly successful at building businesses. And so I think when you just look at the pedigree of LinkedIn, I think it gives you some comfort that this company is likely going places.
Jay Ritter, how do you respond to people that say if the company is so great, why sell it to the public now?
This is a freestanding business. It's not clear that its value would be a lot higher as part of a bigger organization. There are other companies where selling out in a trade sale makes sense, but this is a viable business model by itself. There's one other interesting aspect here that hasn't been commented on. There's been a lot of criticism that on private markets like SharesPost and Second Market that the valuations have gotten too high. But here the offer price is higher than those organizations had been having shares traded at.
Well, indeed, the price of $45 a share is higher than the $6.50 that employees of LinkedIn had to pay for their shares. Scott Kessler, last question for you, 10 seconds. What are they going to use the money for?
I think it's all about increasing the functionality and monetization and international. Think about all the underwriters and the global reach. 100 million users going a lot higher, we think.
All right, I want to thank you very much. Scott Kessler, Jay Ritter, David Weild, appreciate your insights in the LinkedIn initial public offering.